Hi there. So in this video, I'm going to talk to you guys about how to figure out how much you qualify for and how much you can afford when it's time to buy a house. Now, if you have a unique income situation, you're a business owner, investor, just something unconventional, I'm going to talk about unconventional options at the very end of this video, so stay tuned. But for now, I'm going to go over how you can figure out what you qualify for if you're going for a conventional or an FHA loan. The first thing you want to know is for a conventional loan, you're going to need at least a 700 credit score. And the first thing you want to calculate, if you have a 700 score, is your monthly income. So if you're on a salary and you make $5,000 or $10,000 a month, and that's your income, pretty simple, pretty straightforward. That's your number. However, let's say you have a salary and then a portion of your income is commission or bonus. That changes things a little bit. The first thing to keep in mind is that if you're getting a bonus or a commission income, you had to have received that for at least 2 years to be able to use that income and qualify. So if you just started getting commission or bonuses in the last few months, then forget about it. We can't even use that income. But let's say if you have been getting a bonus or a commission for the last 2 years, what the bank's going to do is they're going to take that number, whatever commission or bonus you've gotten over the last 2 years, and divide that number by 24. So for example, if you've gotten $50,000 in commission over the last 24 months, that equals $2,083 a month. You can add that number to your salary. So let's say your salary is $10,000 and your commission's $2,083. Your total income is $12,083. So that's the first number that you need to in the calculations for your debt to income to see what you can afford. So the next number you're going to need is to figure out your total debt, right? So if you have no debt, that's great. Good job, good for you. So that's going to make our calculations a lot easier. All you have to do is figure out what your new payment, your new mortgage payment is going to be. So let's take this scenario. Let's say you're buying a $700,000 house and you're putting 10% down. If you have excellent credit, you're looking at a 6.5% interest rate based on today's rates in January 2024. So if you do the math, your mortgage payment is going to be $4,060. And remember, you're going to have to add homeowner's insurance and property taxes to that number. Homeowner's insurance is typically around $100 a month. So let's use that number for now. And if you're buying a home, let's just say in LA County, property tax rates are about 1.25%. And on a $700,000 home, you're looking at $8,750 a year, which is $729 a month. Property taxes are going to be different all across the country. So what you could do is you could just Google the county that you're looking to buy a home and see what the tax rate is in that county. So if you multiply that tax rate by the purchase price divided by 12, you'll get your answer of what your monthly property taxes are. So in this case, we're going to add those three numbers up. The mortgage itself, which is $4,060, homeowner's insurance for $100, and property taxes of $729 a month, which give us a total of $4,889. So that's the total mortgage payment if you're buying a house in 2024 in January at a $700,000 price and 10% down. So now we have your total income, we have your mortgage payment, and what you want to do is divide these two numbers. So you take $4,889, which is your mortgage, property tax, homeowner's insurance, add those up, that's your total mortgage payment. You divide that by $12,089, which is your income. That gives you a debt to income ratio of 40%. And in this scenario, you would qualify. The maximum debt to income ratio for a conventional loan is 50%. So if you fall below 50%, you should qualify for a conventional loan. Now, if we take this exact same scenario and let's say you have some credit card debt, let's say you have a car payment, that's going to change the calculations a little bit. So then what you have to do is add the minimum credit card payments and the car payment to the mortgage payment that we just calculated, which is $4,889. And by the way, if I'm going too fast, please feel free to pause, rewind, write some of these numbers down just to give you an idea of how to calculate what you can afford. So what we're going to do is we're going to add the credit card, the minimum credit card payments, and the car payment to the mortgage payment that we came up with, $4,889, and then divide that number by your total income, which is $12,083. So let's use an example. Let's just say you have $100 a month in minimum credit card payments and you have a $350 car payment. Okay, so we're going to add $350 and $100, which is $450, to $4,889, and that gives us a grand total of $5,339 a month. We're going to divide that by your income, which is $12,083, and that gives us a debt to income ratio of 44%. So 44, we're still under 50, so we're still good. We still qualify. Now let's say you have more debt and your debt to income ratio is over 50%. Then you have to pay off some debt to get under 50% and qualify. So that's how you're going to go about calculating your debt to income ratio to see how much you can afford. Now, because in this scenario that we just talked about, the debt to income ratio was 40% and 44% with the credit card and the car payment, that means you probably have a little bit more room to get a little bit more house, a little bit of a higher price, and you can keep crunching the numbers. So in this scenario, you could probably go up to probably $750 and still qualify. So you start by figuring out what your income is. Then you could look at a potential house or a condo that you might be interested in your area. And then you could start crunching the numbers. If you have 5% down, 10% down, and do the same process that we just did. Then based on your debt to income ratio, you can adjust up or down to see what you qualify for. Now, the other scenario is FHA. Now with an FHA, you only need 3.5% down, whereas with a conventional, you need 5% down. So let's just say you're going for an FHA loan and the minimum down payment is 3.5%. The credit score requirement with FHA loans are much lower. You can get an FHA loan with as little as a 600 credit score. That's a 100-point difference than a conventional. Now, there is a downside, and the downside with FHA is that you have higher fees. You have an upfront mortgage insurance fee, which is 1.75%, which gets added to your loan, and you also have a monthly mortgage insurance fee, which is 0.55% to 0.75%. The monthly payment on an FHA loan is similar to a conventional loan, and the payment on the FHA would probably be a couple $100 higher. Not a huge difference, but it is going to be a little higher. Now, on the plus side, with FHA, if you have more debt, you can go up to 57% debt to income ratio. So remember, with conventional, the cutoff is 50%. So with FHA, you have a little bit more wiggle room. If you do have some debt, you can go a little bit higher on your debt to income ratio and still qualify. Now, I try to have my clients avoid FHA loans whenever I can. But if it's your only option, it's fine to get you into a home, work on your credit, and then you can refinance down the road into a conventional loan, which will have a lower monthly mortgage payment and no upfront mortgage insurance payment as well. Now, let's get into the unconventional stuff. So we talked about, if you have a salary, if you have bonus, if you're a business owner and you report income on your tax returns, conventional, FHA are great ways to go. But let's say you're a business owner that doesn't show a lot of income on your tax returns. This is the most common scenario that I get. A business owner who makes a lot of money, but they take a lot of deductions on their taxes. So what do you do then? In that scenario, we have a bank statement loan where the bank will take the income, your income, based off your bank statement deposits. So they'll look at your last 12 or 24 months of bank statements. And if you've been depositing $20,000 a month, they'll take usually 50% or more of your deposits and give that to you and credit that to you as income. So if you deposit $20,000 a month on average, then they'll give you at least $10,000 a month in income. Okay, so that's a unique scenario. Also, if you're an investor and let's say you have no income, but you have 20 to 30% as a down payment to buy a house, we have options for you as well. So that's a completely different type of loan. That loan is called a DSCR loan, debt service coverage ratio. Sounds super complicated, but all it means is you put 20 to 30% down. If the rent covers the mortgage, you qualify. It's really simple. But those scenarios with a bank statement loan and a DSCR investor loan are a little more complicated. So you can always click the link below, fill out a short questionnaire, and schedule a call with someone on our team, and we'd be happy to go over and see what you qualify for and get you into your next house. So thank you so much for watching. If you found any value at all, please drop a like, subscribe, and if you have any questions, please leave it in the comments below. Have a great day, and I'll see you guys on the next one.